who are some of the biggest players in the private credit space? What are the names that people should know about? And yeah, can you kind of tell us a little bit more about that? Someone also asked the question of, do the private equity and private credit people is that like one big group of people? Do they work with each other often? How does that look?
Oh,
You
that's
got
a
it. So, when it comes to the biggest names in private credit, you're going to have a lot of overlap with the biggest names that you've always heard of in private equity. So, you just heard Kristen mention Blue Owl, Blackstone. A lot of these
BlackRock.
names, BlackRock, yeah, exactly. A lot of the big names in private credit. You also mentioned Boaz Weinstein. We just saw Dan Loeb from Third Point the other week. There's so many different private credit entities that are all very similar with the Apollos, the Carlyles, the big traditional private capital markets players who traditionally dominated in private equity figured, hey, wait a minute, listen, hang on. People want to give me a lot of money. I can do a lot of stuff with this money. If I need to go make this private equity acquisition over here with my right hand, guess who can lend to it? The left. So a lot of it has been happening in-house and they keep all the returns. But what I want to add on to that though, the most surprising thing has been that in addition to all of the traditional private capital market players, the traditional buy-side institutions, if you will, you also have the banks. So one of the biggest players in private credit is JP Morgan, which I think
Yeah.
is so ironic because it's the traditional lending institutions that effectively got regulated out of existence or out of relevance as a reaction to the global financial crisis, then in fact have been the ones chasing the last marginal dollar in private credit. And so I think that's been one of the most interesting developments as well.
Yeah, and sorry, I wanted to jump in just to make the point that if you think about, by the way, how these private equity firms or the Blackstone, these asset managers really is what they should be called, how they're making money, they make money on assets under management. So, traditionally you tend to think of like 2 and 20. So, they raise $100, they're going to make 2% of that or, $100 million, whatever, 2 million a year, and then they get 20% of the upside. Now, for private credit, it's a little bit less, but regardless, if they're able, like you have a private equity firm who's able to take money to work, charge those fees to buy the company, raise more money from other people. Because by the way, this is not their own balance sheet. This is money that they're going out and raising from other people, right? Raising from Harvard's endowment, raising from CalPERS, Ontario teachers, what have you. So they're raising these different funds and then they're buying the company with equity from one fund. They're lending with the private credit from another fund, and they're making fees on both sides. So again, they tend to attract at the end of the day, it's a business, but like they tend to attract like the best and the brightest, arguably, who want to go work at oh my gosh, I want to work at Blackstone, I want to work at Apollo. And so either you're getting very talented people, but also the fact that like they're off on both sides means they get to make more money. Now, you also do have players that are just in one space. You also there's these things called like business development companies, which is something that we can get into as well. But the point is that you can have these like just only private credit players. But then you also have these behemoths, to Jen's point, Blackstone, KKR, whoever, who are all doing this as well.
Does that kind of sitting in the middle of both the credit and the equity side of that equation, does that create moral hazards or things that like could be problematic in that, or is that just the way that it goes?
Yep, it absolutely does. Because think about it, right? When you own both sides of the company, you are incentivized to, at the end of the day, make as much money as possible, right? You're not going to, if let's say you are the private credit fund arm of insert giant mega fund here, and the private equity arm of said mega fund over here, you own both sides of the debt and equity of a given private company. If all of a sudden things start to go bad, right? You certainly, you would think, do not want that company to fall into distress because things are going wrong in terms of like the revenues that they're creating, et cetera, et cetera. So you might be more willing to say renegotiate terms, et cetera, that might put your investors who are invested in those bonds at risk. Vice versa, if you are the debt holders, you are not likely to impose the same kind of penalties on the same company whose equity holders don't want to be put at risk, who would be the first on the chopping block effectively if the company were to go under. So I do think it does create a moral hazard, philosophically speaking.
I'm actually not so sure, to be honest, because it's funny. We are about to talk to Sajid Indap, who wrote the book Caesar's Palace Coup. And it's a really fascinating book if anyone's interested. But I will say, like, it's a story about the acquisition of Caesars, so like Planet Hollywood, by Apollo and TPG. And they bought this right before the financial crisis. The company headed towards bankruptcy, and the elbowing and like the shenanigans and the screwing over of the other capital holders that you saw by Apollo because they were in the equity piece and not the debt. I will say it might make them play a little bit more fair if they're,
That's what I'm saying. I don't think
oh,
they ever would have played
yeah, but again, they were
as viciously defending their interests had they owned the debt.
yeah, but I also feel like what they did was like should not have been legal. It's by the way is a wild book. Like it's there are concepts in distressed debt. By the way, distressed debt investing is like the coolest thing, but it's like J screwed. Like there's stuff that people do that I mean, honestly, like I would never do to my worst enemy. It's like so horrible, and I think should not be legal. But I mean, so I guess it's like okay, you're not going to try to rip someone's face off. But like maybe you shouldn't be trying to rip someone's face off and play by the rules as they are written. So at the end of the day, it's like if something goes into a bankruptcy, I mean, and this is sort of like worst case scenario. In general, if you are buying a company operates, the goal is to ultimately grow the business, sell, and everybody wins. Like that's what people want. So I actually don't necessarily think it's a terrible thing if you're like, hey, I am operating the business, I am potentially getting into trouble, but I can renegotiate. And again, maybe to Jen's point, the lenders give more favorable terms than they should have because it's owned. So that is possible. But also, you could make the argument that actually they're more incentivized to actually have a more favorable outcome and help the business succeed. So it's not always the worst thing. Think about running a business. If you get a loan from your dad or your parent or a friend, they're like, I really want to believe in you. So again, I'm willing to work with you and like, let's get out of this versus some random person who's like, I'm just going to like take my pound of flesh and screw you over. So I don't
Yeah, that's
necessarily
fair.
think it's always the worst thing. But to Jen's point, again, in a case of bankruptcy, I mean, it might mean that your lawyers aren't fighting nasty, which again, I don't know is necessarily terrible. But by the way, just plug for that book, Caesar Palace Coup. It's like super, super fascinating. Or you can read our pod or listen to our podcast, watch our YouTube on it if that's easier.
Very cool.
But that's a great question.
I appreciate it. I appreciate both of the perspectives of looking at that for sure.
Hey, you made it to the end of the clip. That means you're probably enjoying this. And if so, just know that you can catch us live every Tuesday and Thursday at 12 p.m. Eastern. And if you want to see the full version of this episode, you can click the link in the description down below. Otherwise, YouTube thinks that you will enjoy this next.